Gold is breaking records. Silver is exploding with volatility. Copper is flashing economic signals. Oil is swinging on every headline. Is 2026 the start of a full-blown commodities supercycle? Or are we witnessing the peak before a painful reversal? Because when gold, silver, copper, and oil all start moving together, it's never random, it's a message. And today, we're decoding that message. Why commodities matter. More than most investors realize. Let's zoom out. Commodities aren't just raw materials, they are the foundation of the global economy. Gold reflects monetary stress and currency confidence. Silver bridges industrial growth and safe haven demand. Copper is called Dr. Copper because it diagnoses economic health. Oil fuels transportation, manufacturing, and global trade. When these markets move together, they often signal shifts in inflation trends, monetary policy, geopolitical stability, global growth expectations, currency cycles. And in 2026, we're seeing synchronized movement across multiple commodities. That's not normal noise, that's macro. Gold, the monetary alarm. But let's start with gold. Gold's strength in 2026 isn't just about inflation headlines. It is about three bigger forces. One, quick question. If gold is strong, does that mean the economy is weak? Not necessarily. Gold can rise during inflation spikes, rate cut cycles, currency weakness, fiscal instability. The reason behind the move matters more than the move itself. Silver, the hybrid. Metal, silver is different. It's not just a safe haven asset. It is an industrial metal heavily tied to solar energy, electric vehicles, electronics AI infrastructure, semiconductor manufacturing. In 2026, industrial demand is colliding with monetary demand. That's why silver volatility is amplified. If economic growth expectations rise, silver benefits. If inflation fears rise, silver benefits. But if global manufacturing slows, silver can correct sharply. This dual identity makes silver one of the most explosive assets in commodity cycles. And when silver starts outperforming gold consistently, that's often a late cycle momentum signal. Copper. The economic thermometer? Copper is often called Dr. Copper because it has a PhD in economics. Why? Because copper is used in construction, infrastructure, power grids, EV production, renewable energy. Housing, when copper rises steadily, it often signals expanding industrial demand, infrastructure spending. Manufacturing growth in 2026, copper strength is tied to global electrification trends. Governments are investing heavily in grid upgrades, green energy, battery infrastructure. But here, the catch. Copper is highly sensitive to China. Economic health. If Chinese demand slows, copper feels it immediately. So when you watch copper in 2026, you're not just watching a metal, you're watching global growth expectations. Think about this. Gold rises on fear. Copper rises on growth. If both are rising at the same time, what does that tell you? It suggests a complex macro environment, one where inflation, policy shifts, and growth transitions are all interacting simultaneously. That's not simple. That's structural change. Oil, the geopolitical wildcard oil, is different from metals. Oil is political. Oil is strategic. Oil reacts instantly to Middle East tensions, OPEC plus production decisions, U.S. shale output, global shipping disruptions, sanctions and trade routes. In 2026, oil volatility reflects supply discipline and geopolitical uncertainty. When oil rises, inflation fears can resurface. Central banks become cautious. Transportation and production costs increase. But if oil spikes too fast, demand destruction can follow. High oil prices act like a tax on consumers. So oil sits at the center of the inflation growth balancing act. Is this a new supercycle? Now we ask the big question. Are we entering a commodities supercycle? A supercycle typically happens when years of underinvestment reduce supply, structural demand increases, global capital shifts toward hard assets. Right now we have elements of all three. 1. Mining investment has lagged for years. 2. Energy transition policies are boosting metals demand. 3. Fiscal spending is elevated globally. But here's the caution. Supercycles are confirmed over years, not months. One strong year doesn't define a decade. Before you assume commodities only go up from here, ask yourself, what happens if the global economy slows sharply? What happens if the dollar strengthens again? What happens if inflation collapses? Commodities are cyclical. They don't move in straight lines. The dollar connection commodities are priced globally in US dollars. When the dollar weakens, commodities often rise. Foreign buyers gain purchasing power. When the dollar strengthens, commodities often face pressure. So the 2026 commodities narrative is closely tied to currency dynamics. If the dollar enters a multi-year downtrend, that could fuel sustained commodity strength. If it rebounds, momentum may cool inflation and policy. Crossroads central banks are in a delicate position. If commodities rise too aggressively, inflation could reaccelerate. Rate cuts could be delayed. If commodities stabilize, policymakers gain flexibility. The interaction between commodity prices and monetary policy creates feedback loops. For example, higher oil, higher inflation, higher rates, stronger dollar, commodity pressure. Or weaker dollar, higher commodities, inflation stabilizes, gradual easing, risk assets rally. This cycle interaction defines market volatility, where smart money is watching. Institutional investors aren't just buying metals randomly, they re-monitoring inventory levels, futures curves, contango versus backwardation, ETF flows, mining capital expenditures, energy production data. Tight supply combined with rising demand creates sustained price strength. Speculative excess creates sharp corrections. Understanding that difference is key. Here's a reality check. Commodities often move fastest at the end of a cycle. Parabolic moves feel exciting, but they're rarely stable. The smartest investors focus on positioning, not chasing. So where do gold, silver, copper, and oil go from here? Here are the scenarios. Scenario 1, controlled disinflation. Plus, gradual rate cuts. Dollar softens. Commodities stay supported. Gold remains strong. Copper benefits from infrastructure demand. Scenario 2, economic slowdown. Industrial metals weaken. Oil demand softens. Gold outperforms as a defensive hedge. Scenario 3, inflation reignites. Oil spikes, metals rally. Central banks pause easing. Volatility increases sharply. The key is adaptability. Markets shift faster than narratives, the bigger picture. The 2026 commodities boom isn't random. It reflects currency shifts, fiscal expansion, geopolitical tension, energy transition, supply constraints, monetary uncertainty. Gold signals monetary tension. Silver bridges growth and fear. Copper reflects industrial momentum. Oil dictates inflation psychology. Together, they're telling a story. And that story is about a global economy in transition, not collapsing, not booming uncontrollably, but recalibrating. The next big move won't come from headlines. It will come from watching how these commodities behave relative to the dollar, bond yields, inflation data, global growth indicators. Because when hard assets start moving together, history shows they rarely whisper, they roar. If you found this breakdown helpful, subscribe for deeper macro analysis each week. And I want to hear from you. Do you think 2026 is the start of a commodities supercycle, or are we closer to a peak? Drop your view below. Because understanding commodities isn't about predicting tomorrow. It's about positioning for the cycle ahead. See you in the next video.